Hello, Mavericks. Nice to see you. This is Rob Reinhold, and we are going to talk about some legends, some unicorns, some fairies. Look, it might be true, it may not. I am going to try my best to make this an even presentation of indicators and the good and the bad. I will probably fail miserably at this because I do have quite a bias in this department, but I will try my best to make this a nice, even presentation of just here's the facts. You guys go figure it out on your own. But let me give you just a little background on where what my view is on indicators and where it came from. I started trading back in '97, and the there were like 5 books on trading. There wasn't a whole lot, and when I got my hands on books about indicators, I thought to myself, oh my gosh, I get this. I understand this. This makes a whole lot of sense. When these two lines cross below 20, I buy. And then when these two lines cross above 80, I sell. And a lot of things seem pretty complex out there, but I really grabbed onto this because I'm like, hey, I can do this. And I look back and I back tested it. And I thought to myself, wow, this works. This works. If all you did was click the buy button when they cross below 20 and sell when it crossed above 80, you would have done fantastic. And so I looked at it and I thought, wow, okay. And then I went out into the open market and was not able to replicate that same success. And so this is the biggest problem with indicators is that, they are simple, they're easy to use, and they can give you some pretty impressive back testing numbers. But in the end, it's really about making a profit. And I sat next to a gentleman at the early Maverick trading offices, and I had all my indicators and all my stuff up on my screen, and he had nothing. He just had price action. He just had the candles. And I'm like, you are crazy. Look at this guy. He's a nut job. He doesn't have any indicators on a screen. How is he possibly trading? And then I watched this gentleman make more money than me most of the time. And I thought to myself, he's an idiot. He is so dumb. And then I watched him make more money than me. And then finally I'm like, hey, can I ask you some questions? And basically he told me what I'm going to take you through here is that they give a lot of false signals. They give you a lot of signals to not get into good trades. And in the end, we're all trying to build a system that just makes money. And a lot of people get really highly focused on, oh, this is right 80% of the time. But if it doesn't deliver you a positive expectancy in your trades, it's worthless. So let's really kind of go over what is a technical analysis. Most of you probably already know this. They're simply mathematical formulas. So somebody has decided that they wanted to build an indicator. So what they do is they say, okay, I'm going to develop this mathematical formula. This is how you read it. And this is how it goes. There can be overlays and there can be oscillators. Overlays go over the price of the stock. So anytime you see an overlay, it's going to be listed on top of the stock price. And then you're going to have your indicators, and they're going to be, you can either put them on the top or the bottom. So this is just, again, where we're putting in mathematical formulas. And these mathematical formulas are put together to measure a certain something. I know. And so, let's just take something like a Bollinger Band. Right here, a Bollinger Band. These are these two bands on the side of the stock. These basically measure 2 standard deviations away from the current price of the stock. And it gives you these bands. So that's what it's measuring. It's measuring a 2 standard deviation move, which in statistics, we know that everything 2 standard deviations is like about 96%. So basically, 95%. Everything's going to be between these 2 points. As you can see, it gets outside of that band every now and then. You can see the band will adjust as it gets outside of it. But this is what it's measuring. It's measuring something very, very specific. And that's all it does, is it measures one specific thing. Remember, with all technical indicators, you've got timeliness and you've got accuracy. And if you say, okay, I want both timeliness and accuracy, you want something that doesn't exist. It doesn't exist because in all technical indicators, you need to put in a number. You need to put in your parameters. And based on those numbers, you're going to get either more timely signals or you're going to get more accurate signals. You cannot get both. So when you're going out and you're testing these technical indicators, understand that if the smaller numbers you use, you're going to gain timeliness but lose accuracy, meaning false signals. You're going to get many false signals. If you say, I don't want false signals, I don't want false signals at all, I'm going to go for bigger numbers and I'm going to wait and be patient. When you finally get the signal, there's going to be the majority of the move has already taken place. Because remember, all of these indicators are simply price and volume put into a formula. That's really what it is. It's measuring. And so until something changes, there's really no way for these things to anticipate changes. They can measure changes, but they cannot anticipate changes. And I want to say that again. These do not anticipate changes. They can measure changes. Now, what people will do is they will see, and again, I'm just going to throw out something like a stochastic signal above 80. And a stochastic signal above 80 is typically a good time to sell. At least that's what everyone says is a good time to sell. I actually do not agree with that. But basically it's saying it's overbought. It means right now there is the most amount of buyers that there's been in a long time. And usually at some point that's going to fail, and then the stock will go down. People are anticipating. They are anticipating stochastics is above 80. We're anticipating it's going down. I've seen stochastics stay above 80 for 2 months. So what people do is they take these indicators and they start to use them as predictive indicators, but they're not. They can't predict anything. They can only measure. So when someone tells me, Rob, right now there's a stock that has more buyers and sellers than it's ever been, I'm saying, great, let me buy that one. Wait. Stochastics are above 80. I know that's what it's measuring. It's measuring, telling me right now it's cranking. So again, that's one of the issues. And again, I'm not going to get into, this session is not about technical indicators, how stochastics work, but really it's about a broad thing of like, okay, when do they work and when don't they work? And we're going to go through some of the reasons that they don't work, and then I'm going to talk about some of the reasons they do work. And the reason why they don't work, it's the trader. And I just kind of outlined one of those, where traders use these indicators to try to predict the future. Remember, these indicators measure price action. They don't predict price action. That's a very, very key thing to remember. Very key. Because if you think to yourself, okay, all this is doing is measuring price action, and it's telling you right here, right now, there are clearly more buyers than sellers, that's telling you what you should likely do. So a lot of times it's the traders that take these indicators and the way they apply them, they fail. So we're going to take a look at just a couple of examples here. And this is the biggest one. And this was the one that really, really got me. And is backtesting failure. Now, when you go look back on your charts and you go take a look back, and again, I put up the stochastics indicator down below. And the stochastics indicator, it basically says when it crosses above 80, you want to sell. When it crosses below 20, you want to buy. So we've really got some key signals here. So you can see here, this one, clear signal. But is it? And I think this is exactly what I'm going to look at, because we clearly can see the exact moment these lines crossed. And over here, we can clearly see the exact moment that these lines crossed. In the rear view mirror, it is crystal clear. It is crystal clear that, okay, right here was the moment that those lines crossed. Right here was a moment. Again, right here was the absolute moment it crossed. But guess what? That's only looking in the rearview mirror. Because what happens is, and I'm going to take a look at something. Let's zoom that in here. If we were to be looking at this in real time, day by day, we would have had a cross right here for sure. Now, looking back on it, you would say, oh, well, they didn't really cross there. That would have told you to sell right there. And then another day, we probably got another cross over here. That would have told you to sell. And this one here, we finally got one to sell. What happens is, and then down here, I guarantee you that on one of these days, this line was crossed up above, this black line. And then what happened is the price dropped hard the next day. And what happens is it levels that out. It leveled it out to where, oh, it didn't cross. There's been times where the stochastics have been clearly crossed, but then by the next day, it all smoothed out. And if you were to take a look back in backtesting, you would say, oh, they didn't cross there. They didn't cross. So what happens is, and again, even if you're running a computer backtesting model, where you're actually just saying, hey, why don't you simulate, what if I would have bought, these 500 stocks anytime that a cross occurred below the 20? Again, it's looking at historical data. It's looking at the historical chart. It's not looking at the chart on the day it happened. It's looking at a chart in the rearview mirror. So it's not going to pick up the false signals. So when you go and you apply this in real life, you're going to see that there's a lot of false signals. Just think of how many false signals were in this month. This is 3 weeks. So what happens is, in real life, people take these signals. They take these signals, and then they don't work. They uncross, and so they get out. And then they take the next one. And guess what? They uncross, and it didn't work. And finally, by the time the third one and the real one comes along, they're saying, I don't want anything to do with this anymore. So they just took 2 losses, and it ended up being a decent trade. So this is the biggest issue I have, because if you look back, if you do back testing and you use technical indicators, they do look very clear. But in reality, they're not clear. They're not clear, and there's lots of false signals. This is the one that got me. This is the one where I said, look, it's so clear. How can you miss this? All you do is you buy here, you sell here. When these things cross, when this thing gets up above 70, when this thing gets below 30, I can do that. The problem was, when you put that into the real live market, there's a whole lot of false signals here. So again, and this is what I told you that the gentleman sitting next to me, that's why he didn't use them. He's like, you know what? He said, indicators have kept me out of more good trades than I can count. And I do better without them. And now I'm an adherent of that as well. All right, let's talk about the next reason they fail. Remember, these indicators were built for a specific purpose. They're built to measure something. They're built to measure something. And so what happens is people look at these indicators and they say, oh, I'm going to always apply them to everything. I'm going to always have my MACD. I'm going to always have my McClellan oscillator. I'm going to always have this. And the problem is they were built for a specific purpose. And it's just like going golfing. Can you imagine if you used your driver on every single ball that you hit? You would not be a very good golfer. Imagine if it goes in the sand and you're whacking at it with a driver. I'm actually picturing that in my mind, and I would laugh hysterically if I was golfing and I saw someone trying to get out of the sand with their driver. That would be hilarious. But then again, what if I went to a long par 5 and I saw someone trying to do their tee-off shot with a sand wedge? So there's a tool for the job. And most traders, they don't understand that, and so they just apply them all the time. Now, for the most part, you're going to have them measure three things. For the most part, indicators are going to measure continuation, meaning that there's a move happening. Is it sustaining itself? Or has it reversed? And that's really what what the indicators are about. Some indicators are very good at continuation. Some indicators are very good at reversals. I just talked about stochastics. That's one that actually is pretty good at reversals in a sideways trend. It's actually, if I'm looking at something that's sideways, I will actually pull out the stochastics and put it up on my screen and say, okay, this is, I feel a little bit better about the trade I'm about to make, because this works very well in this situation. In a trending indicator or a trending market, a very strong stock will have stochastics that tell you, don't buy this, don't buy it at all, it's overbought. Right now, again, it might be the best time to buy, but because stochastics are telling you don't buy it, it's not going to. And then volatility, and I got to tell you, I think the volatility technical indicators are probably the most useful. I actually are. This are the ones, and again, we're gonna focus on ATR as one of them. Average true range. It basically is telling you, is volatility rising or falling, and how volatile is the stock at the moment. That's just a great indicator, and that is an indicator that you can actually always use all the time because it's just measuring. It's measuring volatility. You can look at it at any time. Is volatility rising? Is it falling? And again, how volatile is it compared to other stocks? So this is where, again, another reason why these technical indicators don't work is that they're specifically set up to measure something specific. Most new traders don't even understand that, and so they're just using it all the time. They got their driver out on all the shots that they're taking. It really definitely works in specific situations. When we go into setups in the Market Master, we actually will talk about, this is the right technical indicator to use on this setup. So again, if we go into like the high base setup, in the high base setup, the commodity channel index is a very good technical indicator to use. Stochastics is worthless. MACD is worthless on those. MACD and stochastics will actually tell you to not get in that trade. So take out the right tool for the job. And then I kind of mentioned this one earlier, conflicting signals. And again, imagine you have a market bias is bullish. You find a sector that's bullish. You find a trend on a stock that's bullish. You find a pattern that you just love and is great. And then your indicator says, oh, don't buy it. This is what the gentleman next to me said, and this is why I am also not a big fan of indicators, is that I can't tell you how many times I've missed a trade, or haven't made a trade that was a good, solid trade because the indicator discouraged me to do it. And I missed it. I had all the things going for me. Market going my way, sector going my way, trend going on the way, a good pattern on the stock. And darn it, that MACD it didn't look right to me. It just didn't look good. So I passed on the trade and then ended up missing it. The indicators are very, very small percent of your decision. The four things that went before this, market bias, sector bias, trend, pattern, I mean, those are like so important, and what an indicator says, what a tiny little indicator says, is so really insignificant to the success or failure of that trade. So this is the biggest one, I think, also, is conflicting signals, is that you're going to get discouraged if you use a lot, especially if you're trying to apply 2 or 3 different indicators on your screen at once. Of course, there's going to be one that does not work. So let's talk about the proper way to use indicators. Now, I threw out the first one. Don't use them at all. All right. Hey, look, I shouldn't say don't use them at all. Look, I still use 2 indicators. I use moving averages, a simple moving average, and I also use an ATR. And these are technical indicators. So to say I do not use indicators is actually not true. I do use indicators, but those are the only ones that I do use. Remember, support, resistance, candlesticks, and trend. That's going to be the majority of why you should be getting into a position at all. So if you are going to use indicators, find your ones. Find the ones that work for you. Do research on them and find out, oh, this is what this one measures. Like, to me, Bollinger Bands, I'm not a big fan of Bollinger Bands, but I know Corey loves Bollinger Bands, and he uses them very well. I don't like them at all. It doesn't make them good or bad, because Corey has found a way to make them very, very a good part of his trading plan, and it really helps him in his trades, and he believes that it helps him make better trades. And me, I don't believe that. That's both. We're both true. We're both correct in it. It just doesn't work for me and my style. So really, the best thing you can do is go out and try things out. Try things out. Find the ones that work, but really be very, very diligent in trying to understand what it's measuring in the first place. Like, go in and look at the formulas. Go in and see what it is they're measuring. So go in and figure out, oh, this is exactly what it's trying to measure. So in my trading, is that applicable to me? If you are more of a sideways trader, you're more of a trader that does a lot of theta selling, and you really shouldn't be looking at any sort of trending indicators. They're not going to help you. They're not for your style. You're going to be looking at other things. You're going to be looking for things that specifically will help you make your trades better. And then the last one, understand they fail. And not just fail, but fail all the time. And once you understand that these fail all the time, you do start to rely on them less. I really heavily relied on them in the beginning. And it's just because I didn't feel comfortable and confident in a lot of other ways of technical analysis. Once I saw how much they failed and how much, I got myself in a little bit of trouble, I'm going to stay in this one because the stochastics, they're under 20. I bought it, it kept going down, but stochastics are under 20. And every time I've seen stochastics under 20, they bounced and went higher. So I'm going to stay in. I'm going to stay in this one because the stochastics are telling me that it's going to cross and happen eventually. And then 2 weeks later, I finally say, I've had enough of it. And then 3 days after that, yes, stochastics did end up moving higher. So once you understand they're not right. And there's been times in the past 20 years that I've had traders that were in bad situations. I'm like, hey, let's talk about how to protect the situation. And they'll say stuff like, hey, Rob, the McClellan oscillator is below, I don't even know a number on the McClellan oscillator. It's below 5. Every time it gets below 5, it's 98% accurate. I know it's going to bounce here. And whenever they say that, I'm like, oh my goodness. First of all, you don't know. And second of all, what you're telling me is right now is such an extreme price movement that you feel comfortable that this one indicator is going to save it. But anyway, back to the point. It's just a piece of the puzzle. It's just a piece of the puzzle. And if you find that it does help you, use it. Use it and be very comfortable with it. If you find out that it's keeping you out of trades or it's not helping you, dump it. Dump it. There's a lot of other things you can do. All right, well, let's wrap this up. So we talked about overlay versus oscillator. Overlay just goes right on top. Oscillator is going to be above or below. Time frame. And this is where we get back to the timeliness accuracy debate. Your time frame. If you are going to be using technical indicators, make sure that the numbers you're using, every number is going to, or every indicator is going to have a default. Like if you ever look at stochastics, stochastics is going to have a default of 9, 3, and 3. It's a percent K, the percent D. I can't remember the other one, but they're going to have those defaults. Those numbers are going to be important to you. You can find out, okay, what are those numbers? What are they measuring, and what works best with my time frame? If you're a monthly trader where your trades last closer to a month, those numbers are way too small. You need to make those numbers larger, and vice versa. If you're a shorter term time frame, you've got to make those numbers smaller. Backtesting on indicators, even when you run computerized backtesting models, again, they're looking at the chart it is today, not the chart it was on the day it was happening. It's going to give you a false sense of security. So for any of you who are really into backtesting and computerized backtesting, understand anytime you put an indicator in, you're going to probably get better results than you can actually deliver in the real market. And as always, test and practice. And this is the process. If you're fairly new into trading, this is how you become a trader. You say stuff like, I wonder if stochastics would deliver me a positive expectancy. And then you go out and practice it. You go onto like the chartgame.com and you make some simulated trades. You go into a demo account, you make some demo trades, you record it, you measure it, you see, okay, did that make my trades better? If the answer was no, dump it. If the answer is yes, then great. Work on it some more and make sure it's going to be a good thing for you. That is the process of becoming a trader. I always love when any of our traders, everyone gets into trading because of money. Every single one. But at some point in your evolution, it's going to be more about solving this very difficult intellectual puzzle. And just you're curious about solving it. And it all of a sudden becomes more about getting the numbers you want, not the money. And once you get to that point where you're trying to develop your numbers, your win-loss, your profit factor, your expectancy, all that stuff, the money starts to come. But if you focus on the money and not the process, the money doesn't come. So I love it when traders get to the point where they just are testing, because that is where the game is won and lost. All right. Well, hopefully I felt pretty good. I didn't trash indicators as much as I wanted to. But look, like I said, there's the right indicator for the right time. And by learning that, it can give you a little bit of an edge. But do not let these indicators take away your edge. You've got a lot of good things working for you already. So don't let an indicator come in there and undermine everything. All right, thanks for joining, everyone. Take care. Goodbye.